Okay, let's dive in. We're talking about probably the highest stakes retirement in finance right now. Warren Buffett.
The Oracle of Omaha, yeah.
He's stepping down as CEO of Berkshire Hathaway end of 2025. It's really the end of an incredible run, 6 decades.
It really is monumental.
And the numbers from that run are just, well, hard to grasp. You look at the S&P 500 over those 60 years, right? Cumulative return still amazing, over 45,000%.
A fantastic return by any normal measure.
But then you look at Berkshire Hathaway, Class A shares, the aggregate return, it's over 5,960,000%.
It's almost unbelievable. That difference, that gap, really tells you everything about his approach.
So that's the backdrop. He's prepping the handoff to Greg Abel.
Right.
And the market looks, well, historically expensive by a lot of measures. So our mission today is pretty clear. Figure out the one stock he just keeps buying.
The one he can't stop buying, as you put it.
Yeah, and how it fits his core philosophy even now.
And Greg Abel stepping into enormous shoes. I mean, this operation oversees an investment portfolio that's, over $310 billion currently.
Huge number.
So every move Buffett makes now, every dollar he allocates, it's like a final lesson for everyone watching. A signal.
Okay, so let's quickly recap that philosophy. The blueprint, really. We know the basics. Buy for the long term.
Decades, ideally.
Look for strong management, ethical leadership. Capital returns are important, dividends, buybacks.
Definitely.
And maybe, most famously, those competitive advantages.
Exactly.
Votes.
Right, those protective qualities, those are the pillars.
Yeah.
But if you had to pick just one rule, he absolutely refuses to break.
It has to be valuation.
Exactly, valuation. He's famous for saying, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Right.
But the price has to be fair. Or, even better, cheap. If he thinks something's overpriced, he just won't touch it. Doesn't matter how good the company looks otherwise. Berkshire's cash just sits there.
And he proved that, didn't he? Even by bending his other rules sometimes. Like, remember Activision Blizzard back in 2022?
Oh yeah, the arbitrage play.
Totally. That was a short-term thing, pure merger arbitrage. It wasn't a typical long-term hold for him at all.
No.
But it worked because the stock was trading below Microsoft's cash offer. The valuation discount was guaranteed almost. He broke the long-term rule to stick to the value rule.
Precisely. Sacrifice duration for valuation.
Yeah.
And that discipline matters so much right now, given where the market is.
So how does he see the market now?
Well, we have a pretty good idea, thanks to his favorite metric, the Buffett indicator.
Ah, yes. The market cap to GDP ratio.
That's the one. Compares the total value of all U.S. stocks against the country's gross domestic product. He once called it probably the best single measure of where valuations stand.
And historically, what's a normal level for that?
Around 100% is considered fairly valued. When you start getting near 200%, you're in what he'd likely call bubble territory. Dangerously overvalued.
Okay, so where are we now? What's the warning sign?
Well, when you backtest it to about 1970, the indicator recently hit an all-time high, 223%.
Wow. 223.
Yeah. It's not just expensive, it's way out there. It suggests, that the value of financial assets, the stocks, has raced way ahead of the actual economy, the real goods and services being produced.
Implying future returns might be less impressive.
Potentially painful, yeah. That's the historical implication.
And if Buffett believes his own indicator, you'd expect to see that caution reflected in Berkshire's actions. Right?
Absolutely.
Yeah.
And you do. It's glaringly obvious.
How so?
Net selling. For 11 consecutive quarters running from late 2022 right through mid-2025, Berkshire has been a net seller of stocks.
Meaning selling more than buying.
Significantly more, the cumulative total. He sold off a net $177.4 billion worth of stock.
That's a staggering amount of selling, $177 billion.
Just think about that number. It's him voting with his wallet, basically saying, I can hardly find anything attractive enough to buy at these prices. He's building up cash, waiting.
Which makes the next part really stand out, doesn't it?
It really does.
Because amidst all this selling, this massive liquidation over years, there's one stock he has been consistently adding to. Just recently, too.
A little beacon of buying in a sea of selling.
Exactly. And it's the satellite radio company, Sirius XM Holdings, ticker SIRI.
Right.
The latest filings between July 31st and early August show he bought another big chunk.
Yes, scooped up over 5 million shares.
Spent nearly $106.5 million. It just feels so counter to the broader trend of selling everything else.
And it's not just the dollar amount, though that's significant. It's the ownership stake he's building. With this latest purchase, Berkshire now holds, 128.8 12.8 million shares of Sirius XM,
Right.
which works out to more than 37% of all the company's outstanding shares.
37%. He's essentially becoming a hugely influential owner, if not controlling.
Absolutely. He's locking in a major position here.
Okay, so the buying is definitely serious. But now we hit the checklist. The moat, the competitive advantage. Sirius XM is satellite radio. That feels kind of old school, doesn't it? In an age of Spotify, free streaming, endless apps.
It does seem like a legacy asset.
So how does a legal monopoly, as it's sometimes called, in that space have a moat strong enough for Buffett? Isn't that moat, like, drying up?
That's the key question. You're right. And the answer has maybe two main parts. First, that legal monopoly status is crucial.
Okay.
While, yes, they compete with Spotify, podcasts, AM/FM radio, they are the only company licensed to beam radio down from satellites across the U.S. That government-granted license for the spectrum, that's a huge barrier to entry.
So no direct satellite competitor can just pop up.
Correct. And that unique position gives them something most other media companies lack: real subscription pricing power.
Ah, okay. Like a toll road, you said earlier.
Sort of, yeah. Think about a regular radio station if they want more money.
They need more ads, sell more advertising slots.
Exactly. Which makes their whole business model really sensitive to the economy.
Right. Recession hits, businesses pull back ad spending first. Radio revenue tanks.
Immediately. It's very cyclical. But Sirius XM, let's look at their revenue breakdown. First half of 2025. Less than 20% of their net sales came from ads. That's mostly via Pandora, which they own.
Okay, so ads are a small piece. What's the rest?
The big piece, the foundation. Almost 77% of their net revenue came directly from subscriptions.
People paying monthly or yearly fees.
Yep. And subscribers are generally much stickier than advertisers.
Makes sense. You're probably not going to cancel the radio you listen to every day in the car nearly as fast as a company cancels an ad campaign when times get tough.
That's the core idea.
Yeah.
This heavy reliance on subscription revenue makes SiriusXM incredibly resilient. It's set up to perform reasonably well, or at least stay very profitable, in almost any economic weather.
Defensive.
Very defensive.
Yeah.
That combination, the license creating limited competition, plus the sticky subscription revenue that's the modern moat for this business, even in today's media world. It ticks the Buffett box.
Okay, moat established.
Yeah.
But we have to come back to the biggest rule, the unbreakable one. Valuation.
Always comes back to valuation.
We just talked about the Buffett indicator hitting 223%. The market's sky high. So how on earth does this specific stock, SIRI, qualify as historically cheap right now?
We need to look at its specific valuation metrics, particularly the forward price-to-earnings ratio. What are you paying now for its expected future earnings?
All right. What does that look like?
Well, if you look back over the last 5 years, SiriusXM typically traded at an average forward PE of around, say, 12.8. That was its normal neighborhood.
Okay, 12.8 average. And now?
Right now, as of the recent market close when he was buying, its forward PE ratio was just 7.
7, compared to nearly 13 average.
Exactly. That's the whole story right there. It's trading at roughly a 45% discount to its own recent historical average valuation.
Wow. So while the overall market is hitting record highs.
He found one specific, stable, moated company trading at a massive discount relative to its own history.
That's classic Buffett, isn't it? Not necessarily timing the whole market, but finding individual bargains when they appear, regardless of the noise.
He's hunting for mispricings. He believes the market, in its focus on, tech or growth, has maybe overlooked or overly punished this stable asset, creating that discount.
And does it tick the final box, capital returns?
It does. It satisfies that requirement, too. They engage in modest share buybacks, which he likes.
Reduces the share count, increases ownership for remaining holders.
Right. And importantly, SiriusXM also pays a dividend. Right now, that dividend provides a yield of about 5%.
Pretty attractive yield in today's environment.
Very much so. So you go down the list. Long-term view. Yes, it's a durable business model. Moat. Yes, the license and subscription base. Management. Implied trust. Capital returns. Yes, buybacks and a solid dividend. And crucially, valuation. A huge tick, a deep discount.
It checks every single box on his list, but especially the hardest one right now, value.
Exactly. In a market where value is scarce, he found it here.
So as we wrap up, what's the big takeaway from this final buying spree, this focus on SIRE?
Well, I think it's pretty clear. His focus at the end isn't on chasing the next big thing, the high-growth tech story.
No.
His final big plays seem rooted in defensive value. Finding companies like this a legal monopoly, rock-solid subscriptions that are just plain cheap, compared to their own history in the rest of the market.
Stability and price matter most, especially when everything else feels frothy.
Precisely. Which leads to maybe a final thought for you, the listener,
Mm-hmm.
to chew on.
Okay.
The Oracle himself, arguably the greatest investor ever, is making one of his last significant moves into what many would call a legacy media asset, satellite radio.
Feels almost contrarian.
It is. It strongly suggests that sometimes stability and deep, quantifiable value, even in industries that aren't glamorous or are, frankly, a bit unfashionable, can be a much smarter bet than chasing growth when the overall market feels overheated.
So the question for us is,
What other unfashionable sectors or companies might have those same defensive qualities, that same potential for deep value that the market might just be overlooking right now? Where else is the next hidden bargain?